Business Book Summaries.
Insights from Reich, Werden und Bleiben, your guide to financial freedom.
Wealthy people accumulate their fortunes, not just by earning money, but through a deep understanding of how to manage it effectively. When we think about making money through investments, the stock market is often the first thing that comes to mind. However, a 2012 study by German researcher Sharon revealed a surprising fact. She surveyed 472 wealthy individuals, each with assets over 2 million euros, and discovered that less than 4% of them credited the stock market as the primary source of their wealth. This finding underscores the significant difference in how average people and the wealthy perceive wealth accumulation.
Before we delve further, remember that we regularly share new content. Don't forget to subscribe to our channel Business Book Summaries and hit the notification bell for the latest updates.
This book explores these differences and challenges common misconceptions about wealth. Many believe that the stock market is a fast track to wealth, that it's best to diversify investments widely, and that entrepreneurs are the biggest risk takers. However, the thinking of wealthy individuals often deviates from these beliefs. Their unique perspective is crucial for achieving financial independence, which means relying on investments rather than a traditional job. The book highlights 3 key points. First, it emphasizes that wealth isn't just about earning a high salary. Understanding this is vital for financial independence. Second, it points out that true wealth comes from the ability to grow your assets, and this involves overcoming 5 common misconceptions. Third, it identifies 5 essential traits necessary for building significant wealth. One myth the book addresses is that simply having a lot of money doesn't equate to being wealthy. The author argues that money can disappear alarmingly quickly without smart financial management. A large sum today could become nothing tomorrow. Take the cautionary tale of David Lee Edwards, an unemployed American who won $27 million in the lottery in 2001. Overwhelmed by his sudden wealth, he indulged in luxury homes, cars, and even drug abuse. Within a year, he had spent $12 million, and eventually he lost everything, including his properties and his life, dying alone and penniless. His story is not unique. It mirrors a common pattern among lottery winners, including celebrities like Whitney Houston, who died in debt. Studies show that most lottery winners end up worse off a few years after their win, succumbing to the misconception that money alone ensures an easy life. The author, Zitelmann, provides an interesting calculation in his book. He calculates what a German would need in savings to match the average net income of 4,000 euros in 2014, just from interest. The surprising figure is 800,000 euros in the bank, and this assumes favorable interest rates and no inflation eroding the money's value. This example illustrates that even a substantial bank balance isn't always enough for financial security. Being wealthy is not just about having money, it's about effectively retaining and managing it. Holding on to wealth, whether it's 1 million, 10 million, or 1 billion, can be even more challenging than acquiring it. Without proper financial management, even large sums can quickly diminish. Money has a tendency to disappear much faster than we expect. When ordinary people suddenly gain wealth, they often lean towards extravagant spending instead of investing. And those who do invest sometimes fail to do so wisely. Consider the case of Jürgen Schlu, an Austrian warehouse worker who, in 2001, received a windfall of over 700,000 euros. Seduced by the promise of a prestigious insurance company's financial advisor, who assured him of a fail-safe investment that would at least double his money, Schlo invested over 500,000 euros. Unfortunately, the advisor, lacking expertise, directed his funds into risky stock and currency speculation. Within a decade, not only had Schle's initial sum vanished, but he also found himself in debt of 100,000 euros. Like many, Schlu placed his trust in financial advisors from banks or insurance companies. However, as Zland points out, such advisors often act more like sales agents, prioritizing their employers' interests over genuine financial guidance for their clients. By handing over investment management to them, you lose a degree of control and miss out on potential investment success. In contrast, wealthy individuals don't recklessly spend their money upon receiving it, nor do they carelessly entrust their investment decisions to others. They recognize the importance of personally overseeing their investment choices for asset growth, ensuring they can maintain the lifestyle they value. The key is not just how much money you have, but how you manage and grow it. This discernment is what differentiates the truly rich from the rest. This brings us to a crucial point. Merely sitting on a large sum of money doesn't make you wealthy. True wealth involves the continuous cultivation of your assets to sustain a life of freedom and choice. To effectively multiply your wealth, one must move beyond 5 common financial misconceptions. The first misconception involves the often repeated advice, "Don't put all your eggs in one basket." This saying encourages diversifying capital across various investments, like a mix of stocks or different real estate assets. This concept dates back to the portfolio theory developed by economist Harry Markowitz in the 1950. He advocated for strategic diversification as a way to reduce investment risk and secure reliable returns. The theory suggests that the lower the interconnectedness between these investments, the less risky your overall portfolio will be. The widely accepted strategy of not putting all your eggs in one basket is often recommended in investment circles. However, Zitelmann challenges this notion, especially when it comes to building significant wealth. He argues that while diversification can protect against catastrophic financial mistakes, it might also limit the potential for substantial wealth growth. Zitelmann's own experience is a testament to this. 15 years ago, he chose to invest in Berlin's real estate market, which resulted in impressive double-digit returns. Had he spread his investments across various real estate funds, his returns might have been considerably less. If diversification isn't the key, then what is the best investment strategy? According to Zitelmann, it's crucial to have an in-depth understanding of the market you're interested in. Markets emit various signals. For example, rising unemployment figures might be seen as a negative economic indicator, potentially harming stock markets. However, others might interpret this as a sign that central banks will cut interest rates, which could stimulate market growth. Markets are complex, with people buying and selling based on different interpretations, and only time reveals who made the right decision. A deeper understanding of a market puts you in a better position to make profitable decisions. Another common misconception is associating low market volatility with minimal risk. Volatility refers to the extent to which the return rate on an investment fluctuates. Markowitz's theory suggests that lower volatility equals lower risk, but this isn't always true. Economist Michael Kepler highlighted this with an example. One stock might have significant fluctuations, but shows an overall upward trend, while another steadily declines. Under the volatility model, the fluctuating stock would be considered riskier, even though it's actually gaining value, while the steadily declining stock, despite its stability, results in significant losses. This demonstrates that low volatility does not necessarily mean low risk. The third misconception is the preference for domestic investments over international ones. Many believe that investing in foreign markets is inherently riskier than investing locally. This belief, referred to by Zitelmann as home bias, overlooks the potential benefits and opportunities of international investments. By focusing only on domestic markets, this bias can limit the diversification and growth potential of an investment portfolio. The key is to evaluate investments based on their merits and potential rather than their geographic location. A study conducted in 2014 revealed that a significant portion of German institutional investors' real estate assets, over 60%, were located within Germany, compared to just 1.4% in the Asia-Pacific region. This was despite the fact that the Asia-Pacific economy was experiencing stronger growth than Germany's. The investment process in the Asia-Pacific was relatively straightforward, yet it did little to change the deep-rooted investment habits of most German investors. This tendency to invest mainly within one's own country is not unique to Germans. Research has shown that investors from the United Kingdom, Japan, and the United States also tend to favor their domestic markets, often believing they will outperform international ones. Zitelmann emphasizes that this home bias can lead investors to overlook emerging overseas markets, potentially missing out on significant earnings. Studies he references indicate that investors could lose anywhere from 1.48% to 99.79% in potential returns due to home bias. Over extended periods, this loss rate can be quite substantial. The exact reasons for home bias are not definitively understood. Some researchers in Germany suggest that national pride might play a role, observing a link between increased patriotic sentiment and a decrease in foreign investments. Home bias is essentially an emotional prejudice that can hinder sound investment decision. Zellman cautions against confusing familiarity with safety and market contexts, urging investors to base their decisions on solid reasoning and avoid emotional misjudgments. Another common mistake is relying on past market performance to guide future investments, akin to driving while looking in the rearview mirror. Just as drivers use the windshield to see what's ahead, investors should focus on future prospects rather than past events. For example, in 1998, the German stock market surged, leading investors to pour an astonishing 35.3 billion EUR into equity funds, up from just 1.3 billion 2 years earlier. However, after a continued rise, the market crashed in 2002, sparking a selling frenzy over the next 2 years. Investors who entered at the peak lost at least two-thirds of their capital, while those who invested during the market's low point in 2002 doubled their money by 2008. American economist Robert Shiller's study on global stock markets over 5-year cycles found that after a period of strong performance, two-thirds of markets experienced a downturn in the subsequent 5 years. Conversely, 94% of the worst-performing markets saw an average increase of 122% in the next 5 years. These dramatic shifts highlight the risk of basing trades on recent market trends. However, during Germany's market fluctuations, a majority of investors followed this risky approach. Psychologists recognize our susceptibility to herd behavior, which leads people to conform to the prevailing views of those around them, often to their detriment in the investment world. This tendency to follow the crowd, driven by instinctual group behavior, is particularly common among small stock market investors and presents a significant barrier to wealth accumulation. The final fallacy that Zitelmann addresses is the overconfidence many investors exhibit, believing they can outperform most other market participants. In the realm of the stock market, this misconception is particularly prevalent. A 2012 survey revealed that around 70% of German private investors considered themselves better than the average investor. However, their actual returns often did not support this self-assessment. This type of optimism can lead to investment missteps. An experiment involving dice bets illustrates this point well. People are generally more willing to place higher bets before the dice settle. However, once the dice have landed, but the result is not yet revealed, they tend to make smaller bets. This experiment sheds light on the common belief that personal influence can sway the outcomes of random events when they are still undetermined. Once outcomes appear fixed, people's confidence in their ability to influence the result diminishes. This phenomenon, known as the illusion of control, leads many investors to overestimate their chances of success in the stock market. Zitelmann points out that the stock market is predominantly occupied by professional traders, 95% of them who earn their living by researching market trends and operating within sophisticated systems. It's improbable that individual investors can outperform such systems, especially in short-term trading. To avoid falling prey to the illusion of control in stock investments, Zitelmann suggests adopting a Ulysses strategy inspired by the Greek myth. This strategy involves preemptively committing to a plan that acknowledges the market as uncontrollable. Investors make fixed contributions monthly for long-term investment, regardless of market fluctuations, much like Ulysses' commitment kept him on course through dangerous waters. In summary, to effectively grow wealth, first, avoid the trap of excessive diversification and focus on markets you thoroughly understand. Second, do not equate low volatility with low risk. Third, overcome any home bias and explore investment opportunities beyond familiar territories. Fourth, refrain from letting past market performance guide your future investment decisions. Fifth, Avoid overestimating your personal abilities and falling into a false sense of control while investing in stocks. Transitioning to the traits necessary for wealth creation, it's important to recognize these misconceptions and approach investment with a balanced, well-informed perspective. By doing so, investors can make more strategic decisions, potentially leading to more successful and sustainable wealth accumulation. The first and most crucial trait for wealth creation is an entrepreneurial spirit. A 2015 study by UBS and PwC showed that most billionaires worldwide didn't inherit their fortunes, but accumulated them through their own entrepreneurial efforts and investments. But what exactly does having an entrepreneurial spirit entail? Zitelmann believes a key component is maintaining an open mindset. Surveys indicate that while the average person might see trying new things as risky, over 60% of German entrepreneurs are excited about exploring new opportunities. For these individuals, the real risk is inaction, as it can lead to missed opportunities. American psychologist Albert Bandura's concept of self-efficacy, which is the belief in one's ability to handle challenging situations, is also relevant here. German researchers Rouse and Fraze have discovered that successful entrepreneurs typically have a much higher sense of self-efficacy, especially in complex environments. The second characteristic is prudent entrepreneurship. Risk-taking is often mistaken for gambling, but successful entrepreneurs take well-calculated risks and devise strategies to minimize uncertainties. The longitudinal study, Terman's life cycle, suggests that a high degree of conscientiousness is instrumental in entrepreneurial success. Zitelmann advises aspiring entrepreneurs to allow for a transitional period where they don't abandon their current jobs abruptly. Mishandling one's steady employment can increase the risk of business failure. Another important consideration is the required capital, which is often more than initially anticipated. Businesses must be adaptable in their planning to accommodate the many unforeseen challenges on the path to success. Honesty is the third vital trait. There's a widespread misconception that wealthy people have gained their riches through dishonest means, and that integrity is a hindrance to becoming wealthy. This belief stems from the erroneous idea that business is a zero-sum game, where one party's gain is another's loss. Contrary to this, Zitelmann emphasizes the significance of mutually beneficial business relationships. A prime example is when Warren Buffett purchased a furniture store. On his first inquiry, the owner valued the store at $40 million, and without any detailed auditing, Buffett immediately wrote a check for that amount. The next day, the owner was surprised. To Buffett, the store was genuinely worth the price. Furthermore, Buffett has stated that when hiring, he looks for three qualities: honesty, intelligence, and energy, with honesty being the most important. Without this virtue, an employee's other attributes are of little value. In summary, to cultivate wealth, one must embody an entrepreneurial spirit, engage in prudent risk-taking, and uphold honesty. These traits, combined with a strong sense of self-efficacy and a willingness to explore new opportunities, are essential for navigating the complex journey of wealth creation. Intelligence and energy, while valuable, can become detrimental to a company if not tempered with honesty. The fourth characteristic vital for wealth creation is frugality. Contrary to the common image of the wealthy living in opulence, studies from the US and Germany reveal that many affluent individuals avoid extravagant spending. Instead, they might choose to repair their old shoes or switch telecom providers to save money. This behavior is rooted in a preference for asset growth over immediate gratification through consumption. The final key trait for cultivating wealth is the establishment of clear financial goals. Is setting out to earn $1 million an unattainable target? If you believe it is, you're already limiting your potential for wealth creation. Research has demonstrated a link between entrepreneurs who set ambitious goals for their businesses and the high success rates of those enterprises. To move towards financial independence, one must have a clear understanding of their objectives and the reasons behind them. Zitelmann advises writing down the financial goals you aim to achieve in the next decade. People often overestimate what they can accomplish in a year, but underestimate what can be achieved in 10. A study by American academic Werden and colleagues in 2008 suggests that many significant human achievements were realized over a span of 10 years, making a decade an appropriate timeline for fulfilling financial ambitions. Upon setting a 10-year goal, it can be broken down into smaller, achievable annual milestones. If your aim is to make $1 million over 10 years, earnings are unlikely to be evenly distributed each year. You might accrue modest sums initially, followed by exponential growth later. Therefore, setting realistic interim goals is crucial. Zillman emphasizes that current financial circumstances reflect one's current mindset, implying that without altering a mindset hampered by fear of failure and self-doubt, achieving wealth is unattainable. To summarize our discussion today, we've covered 3 pivotal points. Firstly, our concept of wealth. If we view wealth solely as significant income, financial freedom will remain elusive. Wealth is not just about maintaining resources, but ensuring their growth over time. Secondly, we analyzed the importance of dismantling 5 ingrained cognitive biases to master wealth expansion. Avoid over-diversifying and invest in markets you deeply understand. Don't mistake low volatility investments for being low risk. Overcome home bias and embrace a broader investment horizon. Avoid investing based solely on historical data, and don't overestimate your expertise in the stock market, avoiding false illusions of control. Lastly, the third focal point includes essential traits for generating wealth: embracing an entrepreneurial spirit, adopting a meticulous approach to business, maintaining integrity, practicing frugality, and having the courage to aim for ambitious financial outcomes.
We're keen to hear your thoughts on our content. Feel free to share your opinions or recommend books in the comments section. Don't forget to subscribe to our channel Business Book Summaries and hit the notification bell to stay updated with our latest summaries. Thank you and have a wonderful day.